Hello everyone and welcome to a market update. Today is the 1st of November. It is Wednesday and there is a lot going on this week. A couple of big events I'm going to touch on here in just a moment. Top three things today are going to be the U.S. and the Reserve Bank of Australia, so the U.S. Fed and the Reserve Bank of Australia, and interest rates and the policy settings that we may very well see in the coming week. Number two is the fact that we are in a bear market. So I'm just going to talk about what's going on broadly with the market and the fact that we're in a bear market and what I think is going to happen next as this continues to unfold. And then finally, I'm just going to discuss as part of that whole bear market discussion is a bit more about the underlying conditions that are going on in the U.S. market, Australia, and maybe even a little bit in Europe. But first, let's talk about the U.S. Fed. So tomorrow or overnight, we're going to have a policy announcement from the U.S. Federal Reserve. They're in a two-day meeting today or yesterday, which was the 31st, and today, which will be the 1st, and we'll get a policy decision overnight from this man right here, Jerome Powell. And who knows? Who really knows for sure what they're going to do? Now, the bond market has been increasing interest rates. So when I say the bond market is increasing interest rates, I think you all know very well by now that the bond market actually sets the medium to longer term interest rates. The Fed really influences the short term interest rates. So everything from 1 month to 2-year treasuries, the Fed plays in that space. They do issue longer dated treasuries, but broadly the way they control interest rate policy is by moving around the shorter term rates. And we have been seeing the 2-year, the 10-year, and even the 30-year U.S. Treasuries and T-bills moving higher in the last week to week and a half. So to give you an example, if I go back to, say, I'll just flip to a page of my notebook here. The 12th of October, the U.S. 30 was sitting around 485. This is 4.85%. The 2-year was sitting around 507. Now, fast forward about 15 days or so. It is a bit more than that, obviously, but 18 days, let's call it 19 days. The 30-year has moved to 509, and the 2-year is just sitting a little bit above where it was previously at 508. And so anyway, the market, I think, has generally been pricing in that rates are going to continue to increase because, of course, we had some really bad inflation data. Or when I say bad, I mean inflation data that wasn't going the direction that we really wanted to, which is to continue down. That happened both in Australia and in the U.S., where inflation has actually ticked up. And we got the inflation data for Australia last week. And what's interesting about the Australian inflation data is I think it's going to pretty much guarantee we're going to see an interest rate rise on Melbourne Cup Day. And to support that, I noticed today there was a, where is it, right here, this article that has appeared on the Sydney Morning Herald website. Borrowers warned to prepare for Melbourne Cup rate rise. Now, why would you put an article like this in a major newspaper? And this will obviously filter out to all the other regional papers in Brisbane and Melbourne and Perth and Adelaide. And I'm sure this article is probably on the front page of every single one of those websites. But it's interesting because I think we're going to see a rate rise tomorrow, and on Melbourne Cup Day, next Tuesday, rather. Excuse me. And so what is that going to mean? Well, we'll get to that in a moment. But interestingly enough, and to touch on the Australian interest rate market, if I go back to that 12th of October, and this is prior to that inflation data being reported, the Aussie 2-year was at 404 and the 15-year was at 473. Now, probably a more realistic rate for interest rate policy is probably the 5-year, which was at 409, and the 10-year, which was at 447. So those are Australian government bonds. So just to reiterate, 2-year was at 404, 5-year 409, 10-year 447, 15-year 473. That was back on the 12th of October. Fast forward to today, and the 15-year, actually I'll start at the low end. The 2-year has now jumped to 452. That's almost 50 basis points higher. That's a pretty big move in 18 days. The 5-year is sitting at 459, so that is a 50 basis point move. The 10-year at 499, again a little over 50 bips. And the 15-year is at 525, again, just about 50 bips. So we've seen a 50 bip increase across the board in Australian interest rates. So we'll see what the RBA does. We'll see what the Fed does, I guess, because the bond markets, as I have talked about many times before, they set the price of money. And and what we've seen is they are saying money's not expensive enough, or the interest rate isn't high enough, because we still have this lingering inflation problem. So I think, again, we'll probably see some sort of interest rate rise. Now, is it going to be 25 basis points, or could it be something lower? Could it be 15? Well, it could be. But if it is an increase, it's an increase. If they say, well, the bond market has already adjusted rates and we're just going to continue to wait and see, that's not a cut. And of course, it's not going to be a cut. So for probably the better part of this year, the entire year of 2023, and even I'm sure at the end of 2022, one of the phrases I've been saying and using with all of you in these market updates is that until we see interest rates being cut, the next part of this movie doesn't really begin. And that is to say that we're going to have a continued downward, well, sorry, let me rephrase that. We're going to have a continued cost of capital, which is elevated, and that's going to impact and continue to flow through the economy and have impacts in other parts of the economy, not least of which will be the stock market. So getting on to point number 2 is this bear market that we're in. Now, we are absolutely in a bear market if you look at it from the cycle perspective, which is to say that the peak in most markets occurred around November of 2022. And since that time, we have seen downward movement in all markets: S&P 500, Australian All Ordinaries, European markets, the Russell, the NASDAQ. You name it, pretty much every single market is down. Notwithstanding, there's a few markets that have actually had strength, including Japan and India, but Japan looks like it may have broken down, so those positions have been taken out of the portfolios, and India is maybe teetering. We'll just have to wait and see what happens there. But anyway, I think you could make an argument that we're probably in a global a period of real global turbulence. I'm just going to get rid of that. Real global turbulence. But there are some segments of the stock market, and this is kind of what I want to talk about in point number 3 too, which is the underlying conditions. Before I move to that, though, we are only in probably chapter 1 of this bear market. So GDP, so there's a couple of things. Let me just talk for a second about economic data. There's a couple of things that aren't yet catching up to where the market is at. One of those things is GDP. So we've had a pretty good GDP print in the U.S. I think we had the GDP print 2 weeks ago, or maybe it was last week as well, and we had some positive GDP numbers. They were good. This means that the Fed will have cover to continue to raise interest rates. Of course, we've had the inflation data, which is also supportive of potential further interest rate increases. And the economy broadly is breaking down, but it hasn't full-on cracked yet. But it's on its way. And part of that whole story is the cost of money, that interest rates are elevated, and the fact that a huge swathe of the American population, and I dare say the Australian population, are really struggling under the weight of the cost of money. And it takes time for those things to play out. So, so the bear market, alive and well, not finishing anytime soon. This is a movie that's going to keep playing and will probably continue through the end of this year and probably into early next year. We'll just have to wait and see what happens. But one of the things I wanted to highlight, and I've got this sector performance table here on the screen in front of me, and I want to just go through a couple of things. I want to draw your attention mainly to the year to date, which is calendar year. So this sector performance table is measured in calendar year. And I want to just highlight a couple of segments. So there's a lot of red on this table, and then there's a little bit of green. Now, all of these ticker symbols here are ETFs except for this final one here, the SPY. The SPX is the S&P 500, but all these other ones are exchange-traded funds. Many of them you might be familiar with. They've ended up over time in and out of portfolios. But there's 3 notable standouts, and I'm going to I'm going to draw this full circle here for you in a moment. But XLY, which is a consumer discretionary ETF, the XLK, which is a technology ETF, and the XLC, which is a communications ETF. Now, their year-to-date performances are all killing it. Now, I want to ask you this question. How many of you, and some of you may know, but how many of you actually know what the largest holdings of these three ETFs are? I'm not going to make you go look it up. I actually am going to tell you what the answer is. And it may not surprise you that these three ETFs, between the three of them, all own as their top holding, and I'll go through that in a second, as their top holding, the 7 stocks that have performed the best and given the performance this calendar year in the S&P 500. And that's why the S&P 500 is up. So bear with me for a moment as I go through this. So let's start with the XLY, consumer discretionary. The top 2 holdings in this ETF are Amazon and Tesla, and I think they account for something like 12 or even more percent of that ETF, a huge chunk of it. XLK, which is the technology ETF. Broadly, technology has been completely hosed, except for Apple, Microsoft, and NVIDIA. Those are the top 3 holdings in the technology ETF. And then finally, the communications sector. You can probably guess which names I'm going to say here. So see if you can guess. I'll give you 5 seconds to guess what I haven't named. If you guessed Meta and Google, you guessed correctly. Those are the top 2 holdings in the communication sector ETF. Now, those are 7 stocks that have accounted for something like 90% of the S&P 500's performance year to date. You take those 7 stocks out of the S&P 500, and the S&P 500 is down something like 6%. Let me see. 3% year to date, which is not great. I think the equal weight S&P 500 is down even a little bit more. So the point I'm trying to make here is that the underlying market is in a lot of trouble. The number of stocks that in the S&P 500 that have, how do I phrase this? I'm trying to remember exactly how to phrase it. Something like only 31% of S&P stocks are actually trading above the S&P 500 return this year, so are up 3% or more, something like that. Most of the S&P 500 is actually really struggling. And again, if you take out these 7 stocks that I just discussed out of the S&P 500 metrics, then the S&P 500 is down for the year. What's happening right now is that those 7 stocks, which are arguably probably account for a market cap of somewhere around $5 or $6 trillion. I mean, Apple and Microsoft and Amazon alone, I think, are about $4 trillion of market cap. Google's probably up there, so it could even be $7 trillion of actual market cap. They can provide tremendous liquidity for a lot of large hedge funds, managed funds, etc. And there's a lot of players who have piled into those stocks. Now, what's happening is the leadership of these 7 stocks and the liquidity that's in them, it's starting to fade. And we're starting to see that now, particularly if you look at the quarter-to-date and month-to-date returns in those ETFs. You can see XLY down, month-to-date, quarter-to-date. XLK down, month-to-date, quarter-to-date. Although not as much, but down. And then the communication sector as well, down, month-to-date, quarter-to-date. So again, we're seeing that the leadership and S&P 500 down. So we're starting to see that these leaders are losing their shine, if that's what you want to call it. And once they crack and break down, we're headed for some real serious problems. And will that happen? Well, Apple reports earnings on Thursday, I think after the close, which will be Friday, or possibly we may not get that. Let's see, Thursday after the close. Yes, it'll be Friday our time. We should wake up to having heard what Apple is reporting in terms of earnings. And it may not necessarily be what they report, so they could have a good quarter. It's very possible they might beat expectations, or they might meet them. Certainly, if they do not hit their earnings mark, that's going to be problematic. Even if they hit the earnings or they exceed them, it's going to be what they say about their forward guidance. So if they miss, that'll be a problem, and then forward guidance will probably indicate that they're going to continue to have problems. But if they make the number and then they have forward guidance that is suggestive of weakening economy, global economy, weakening earnings going forward, that's also going to be a problem. So really, I guess what I'm saying is no matter how you cut it, the Apple earnings report may very well be problematic for the market. And that could be that final tipping point where if Apple gives us a bad quarter or indicates that the next few quarters are going to be a struggle, we could very well see that the Magnificent Seven, as they're being called, start to teeter and fall. So Tesla's a great example of that. Tesla's in that group. They had a pretty average earnings report, and they're cutting prices. Their deliveries are down. All these other metrics are going on. They're a consumer discretionary stock at the end of the day, and so Tesla has gotten beat up pretty well and may continue to go down. We'll have to see. But these other ones could very well be the final straw that breaks the camel's back of this market really going into a serious correction. What else did I want to say about underlying conditions? So just quickly on economic data, we continue to see really poor reporting data out of places like Germany and France and Italy and Austria and the UK. The economies there are not doing well. The manufacturing sector is not doing well. And I think we're going to be getting close to a point where the ECB has to acknowledge that even though they're trying to fight inflation, they're going to have to start cutting interest rates over there because they've got to stimulate economic growth. That's going to put Europe into a really interesting spot because if inflation doesn't get under control, and you could say this about anywhere, really, you could say this about the US or Australia for that matter, if the central banks using the mechanism of interest rates are too quick to cut rates or cut them too hard, they could reinvigorate inflation and put us back in the 1970s scenario where the central bank has to go back in and raise interest rates again. That would be a total shit show if that happened in Europe. And I think the U.S. is going to be a little bit more cautious around how they Jerome Powell would be more cautious about how he manages the interest rate environment. He's already said that rates are going to be higher for longer. So even if we don't get an interest rate increase on tonight overnight from the Fed, I'm sure his commentary is going to be, well, we're going to continue to wait and see what the inflation data does. And we're hoping to get that down. Let's see, is there anything else I wanted to mention? I talked about sector performance. Broadly, was there one other table I was going to show you guys? It's a correlation table I think I was going to show you, but anyway, there's a couple of charts. German DAX, down massively over the last 6 or 8 months. Here's Ford Motor Company. I'm not sure why that chart was put in here, but this is a proxy of the broader economy. If people aren't buying cars, then stocks like Ford Motor Company get absolutely caned, and that's because their earnings are going to be down. So I guess the point around even highlighting a chart like this is to say that we're going to be continuing to go through this earnings revision cycle and this reporting of not just poor earnings but forward guidance of lower earnings, which is then going to reprice the stock market. Like the stock market had just been levitated, and in particular in those 7 names for a very long time. And so we're in a correction phase, and we're just moving through that now. Actually, one of the things I will quickly hit for you is the volatility metrics. Just grab this chart here of the VIX. We have seen volatility bounce and push back up through the sort of 20 barrier, which 18, remember, is when we get from 18 to about 27, 28, that's referred to broadly as the chop bucket, where we just get, market swings up and down. And, and we're seeing that happening right now. So vol has come back down a little bit in the last couple of days, but it's still elevated, still around that 18 level. And does it stay there? Does it spike up? Not entirely sure. We'll just have to wait and watch and see what it does do. My bet would be on if interest rates do get increased, we'll probably see volatility spike, and then if we see all of that start to feed on itself, we could easily get a situation like we were back in March or so, where vol popped right up into the mid to high 20s, and we have a bit more of a correction afoot. So for now, what I've done is I've raised cash in portfolios, and my intention is, and I'll be communicating with a number of you about this, to put that over into, or suggest anyway, that you park that in the Keystone Cash Flow setup, which is, of course, most of those monies are invested with the Palace Group. And in fact, just quickly, I had an awesome meeting with their head of risk. He's their head of credit, head of risk. Last week, I think it was on Tuesday, and I spent about an hour just talking about how they manage risk, how they mitigate risk, how they model risk, and things they look out for as early warning signs, and just any other general commentary that they could offer me, so that I could be very comfortable with how they manage risk across their portfolios of what they invest in terms of property development and projects. That's another quick thing I was going to mention, was the housing market. So to lock that thought off, I came away feeling even more comfortable and confident with the way Palace Capital manages their projects, their loan book, everything, and am keen to set more money with them, because they are truly a very professional and well-oiled and well put together business. Very impressive. Just quickly on the housing market, I was at a conference last week where we had an update from Tim Lawless, I believe is his name, from CoreLogic. I think it's Tim Lawless. And he gave a pretty good broad update on the Australian housing market. And I think in the short term, anything can probably happen. I think if interest rates continue to rise, we'll see pressure in the housing market. But longer term, the reality is that we do have an undersupply of housing, and we do have immigration and other things that are going to be impacting supply. And so I think the case longer term for housing in Australia, it will remain, I don't want to say bullish, but will remain very stable, and we'll not see, we probably won't see some big correction unless there's some catastrophic event that happens either with interest rate policy, or I don't know, maybe a war or something like that, where Australia gets embroiled in that. I think the housing market generally should continue to just kind of slowly tick higher. Notwithstanding, I'm sure there'll be spikes and there'll be some drawdowns. But my takeaway from it all was that we are not building enough. We will need to build more. This is going to keep sort of prices stable and rising. Most markets have been have weathered the storm. I think Sydney and Melbourne in particular have come off some of these peaky sort of numbers that we've seen recently, and are just probably returning to more normal, say 1 to 3%, 1 to 5% type per annum growth. Most other markets, I think Tasmania was the exception, where Tasmania wasn't doing great, but every other market in Australia was holding up. Adelaide, Brisbane, and the Sunshine and Gold Coast regions, Southeast Queensland, Perth was doing well. So again, broadly, housing is going well. So I think I'm going to leave it at that. We're almost at 25 minutes, and if you do have any questions, or you'd like to schedule an appointment with me to go through anything, you can certainly do that from my email footer to book an appointment. Just as a quick, and I'll do another market update before I go, but I will be traveling to the United States. I'm going over to visit family for the Thanksgiving period. I'll be over there from the 15th of November to the 1st of December, back on the 1st of December. Obviously, I'll continue to work and do things while I'm there, but I will be out of the office during that period. But between now and then, if you do have anything and you want to have a chat with me about anything, please do not hesitate to book yourself into my calendar. And with that, I will wish you a fantastic rest of the week and a happy weekend. Talk to you all again soon. Bye-bye.